Hello, I'm Declan Curry, and today we're going to talk about a new pension scheme from IPSE, the Association of Independent Professionals and the Self-Employed. With over 21,000 members, IPSE is the largest association for independent professionals in the EU, representing freelancers, consultants and contractors in every sector of the economy. IPSE recognises the importance of saving for your future and also realises that not everyone's needs and aspirations in life are the same. So it's teamed up with the pension company Aegon to offer a scheme that's designed with the self-employed in mind. Remember, everything we talk about today is information. It's not financial advice. We'd suggest that you get your own personal advice from an independent financial advisor. And also that this scheme may not be right for everyone who is self-employed. Suneeta, why is IPSE offering a pension scheme at all?
Well, here at IPSE, we've always believed that independent professionals should be thinking about their futures, and just because you're not in permanent employment doesn't mean that you should miss out on retirement support. So this scheme gives our members access to group rates rather than a higher rate individually. And as you mentioned, Declan, the scheme might not be for everyone, so we do advise members to speak to their financial advisor about any scheme that they are considering.
So Frank Meaden from Aegon, lots of pension companies out there. Why yours?
Aegon have been around for a very long time, helping people prepare for their financial futures. Back in 1831 up in Edinburgh, we were established. For most of our life, though, we were known as Scottish Equitable. Became part of the Aegon group of companies right in the late 90s. Now we are active right across the world, headquartered in the Netherlands, but our UK headquarters are still up in Edinburgh. We're passionate about helping people and helping to understand what the future could be like and helping them to prepare for those futures. What we've done now is we've harnessed that experience together with some great IT solutions to enable people to access their monies and their savings in a very upfront way and to really live with them and to make their retirement preparation very much a part of their day-to-day life.
Well, give me some information about this scheme. What is it?
Okay, this is a group self-invested pension plan. You all have your own individual accounts grouped together with the other members across the organisation in order to capture your wide purchasing power, which reduces the price that Aegon is able to offer this at and increases the level of service we're able to offer it as well. But you've got your own accounts, all the money in there, you own that money and you have some control over it. The money comes either by way of an employee or an employer contribution. It comes to us, we invest it with the objective in the long run of at least keeping pace with inflation. And then at some point in the future, you're able to access those monies in order to actually go ahead and to retire at that point.
So it's a group scheme. How much control does the individual have over how much money they put in and where that money goes?
Okay, both those questions are answered by the individual, or perhaps the individual's advisor, actually. Certainly how much you want to contribute to it will depend on your own personal financial circumstances and your own objectives when you eventually reach retirement. We would like to see people start to contribute as young as possible, but to make sure their contributions are affordable. So we don't want you to make contributions into your pension plan, but at the same time build a credit card debt in order to pay the groceries. You've got to get a good bit of balance there. So if you have some very ambitious, perhaps early retirement goals, then you might want to contribute a little bit more. And we have a range of calculators that are designed to help you to decide how much you want to contribute and how much is affordable for you to contribute as well. The primary one is something called Retire Ready, where you would go, gain a score that would determine how well you are on track towards your retirement and help you to make some decisions based on good quality information. Second part of the question, I think, was about where you're going to invest that money. Okay, that's an important aspect as well. 2 points to that. First of all, the scheme does have a default investment fund. So if you're unsure about where to invest and you don't know how to make that decision, there's a fund that's been selected for you by Mercer, which is IPSE's pensions advisor. It's a balanced fund that's designed to invest your money very, very widely across geography and very widely across different assets, different things that are all together inside that fund. If you look at that and either you or your advisor determines that it's not suitable for you, then we have a wide range of alternatives from very passive types of investments to much more aggressive ways of investing your money if that's suitable for you.
But again, it's an individual decision.
That's right, yes. Up to you.
And if you move your money, you have the freedom to do that, to move from one fund to another?
You certainly do, yeah. So if your fund is suitable now, but economics moves on, or perhaps you get a bit older and it's no longer suitable for you, you can create yourself your own investment portfolio if you want to, moving money around from one investment strategy to another as you see that economic cycle unfold.
As often as you like, as little as you like?
Well, pretty much. Bear in mind, it takes a bit of time for the trade to be completed. We've got to get your money from your current advisor, and we've got to send it off to your new provider, and that may take a week or so to do. But I would imagine, for the most part, you can probably trade on a weekly basis.
I'm just wondering who's taking the risk here
Yeah.
of making the right choices. It sounds like the individual has to take some of the risk themselves.
Yes, that's absolutely vital to understand that. Your money is at risk if you're invested in a scheme of this nature. Almost certainly you're going to be invested, some of it at least will be invested in the stock market. We know the value of the markets do go down as well as up. In the long term, the trend is generally up the way, but there are times when, for the short term, even for the medium term, you may see that the value of your fund has declined.
So how much does Aegon cream off the top here? What are your charges?
Well, cream off isn't really a very pleasant term, but what we do is we unbundle these charges, try and make them as transparent as we can. So there's two specific charges that you'll pay. The first is a charge for actually using the online service, our administrative fee, if you like. That amounts to 0.18% each year. So that's 0.18% of the accumulated capital every year. The second charge is the charge that will go off to the fund manager to meet their expenses. That will vary depending on the investment fund you select. The default fund that I think many people will choose to use will come to you at 0.24% each year. But if you feel that's a bit steep, we have a lot of funds a little less expensive than that, and the least expensive fund is a fund that comes to you at 0.05. On the other side, though, there are a wide range of different investments available to you at a wide range of different charges, depending on exactly the way you invest. So if you use a discretionary fund manager, for example, their charges would kick in. If you choose to select your own individual shares, then of course there'll be charges associated with trading those. So the charges could be considerably higher.
And you talked about moving money from one fund to another. Are there hidden charges in there? Do we need to watch out for them?
We try to be as transparent as we can about the charges. So if you switch from one fund to another, there shouldn't be any charges associated with that. Particularly if you use Aegon's insured range of funds that we make available to you. If you go into the wider retail world of funds, with something like 2,500 funds, some of those do have what we call initial charges, and you should certainly use that information to determine whether or not you want to select those particular funds. It will be part of the research you do before you actually choose a fund you want to invest in.
That information will be clear.
Oh, absolutely. It's all available to you at aegon.co.uk/funds.
Where does the money come from? Who puts the money into this fund?
Yeah, okay. Well, there's a number of options there depending on your own individual circumstances. If you are an employee of your own business, you can contribute as an employee, or your business can contribute instead if you prefer to do it that way. If you are a sole trader, then you can contribute yourself as a sole trader. So it depends on your own circumstances. We would probably imagine that you would be guided with that by your accountant or whoever it is that keeps your books to try and make sure that the tax burden is kept to a minimum.
And there are limits on how much you can pay.
Yeah, there are, Declan, there are. Currently this year, you're able to contribute £40,000 and get tax relief on that. So if you contribute more than £40,000, you'll get a tax bill. If you haven't used your limits in previous years, you can bring those forward. And that's the sort of calculation that your accountant or your advisor would do on your behalf.
This is locking money away for the long term. It's important to remember that you may be saving for many years before you can get access to this money.
That's right. So this isn't suitable for those of you who are preparing to buy a house and you're looking for a deposit, and when you're 40 you want to take the money out to buy your house with. Now, within this whole solution, this investment solution, there are other tax wrappers available. So you can invest in an ISA, an individual savings account, or a general investment account, and those sorts of products are more suitable for people who want early access to their money. But if you're putting money aside specifically with retirement in mind, access at the moment is 55, and they're increasing, the government is increasing that minimum age hand in hand with the state retirement age increasing. So it's 55 now, it'll go up to 56 and 57 and on, probably it may be even as much as 60 at some point in the future. But at the moment it's 55.
And when you reach that golden time,
yeah,
when you are able to enjoy your retirement savings, how do you get the money?
Well, again, there's a lot of flexibility and an increasing amount of flexibility available at that time. The first thing is that this will provide you, if you want, 25% of the fund that you built as a tax-free lump sum. So you put that money in tax-free because of tax relief. There's very little tax on the actually accumulating fund, no capital gains tax, for example, and then you're able to access a quarter of that money as a tax-free lump sum. That's a very nice benefit that we've got. The rest, though, would come to you, depending on your own circumstances, probably as an income. Most people do select an income option of some description. You can go for a secured income if that's suitable for you, where an insurance company, maybe Aegon or one of our competitors, will promise to give you a certain payment every month. That's called an annuity, and that is taxable. Alternatively, you can keep your money invested, retain ownership and control of that lump sum, but draw down whatever amount you want to every year. Again, a taxable amount. So if you do take very large sums of money out of your pension fund, maybe even all of it in 1 year, that entire lump sum goes on top of your earned income that year for tax purposes. So it can be very punitive tax-wise. And of course, there's a very good chance if you take all of your money out early that you'll outlive your savings. So there's a risk to longevity as well.
Of the money running out.
That's right, yes. Yeah.
And important to remember that that's the tax position today.
Well, that's absolutely right, yeah.
That may change by the time you reach retirement.
That's right, Declan. It really is on the move. When it comes to pensions, one thing we do know about them is that they'll change.
Suneeta, this is a saving plan that could last for decades. In that time, you could stop being a freelancer and become a permanent employee. What happens then?
Well, one of the great things about this scheme, Declan, is that if you do move into permanent employment, you can still access and stay on the scheme. So if you're not an IPSE member in the future, you have nothing to worry about.
So the money is still there?
That's right, Declan. It's yours in your account waiting for an instruction from you. That instruction might be that you want to continue to invest it, keep it in the same investment fund. You can move it around to the other funds that are suitable for you. You can at a later stage start contributing again. Your new employer can contribute to it if they are willing to do so. Or of course, if you want to, you can simply lift this money up from Aegon, transfer it to your new employer's pension scheme if they're willing to accept it, and Aegon won't make a charge for that transfer.
So Suneeta, we've heard the information, we've taken the independent financial advice that's been suggested and spoken to our accountant. Now what do we do?
Well, for more information on the pension schemes available to you, you can just go to the website, so ipse.co.uk, and if you go to the Futures section, IPSE Futures, you can find out all the information that you need there.
Frank, Suneeta, thank you both very much.